Hello and welcome back to Dukascopy TV. I'm Monica Gibson and I'm joined in the studio by Daniel Murray and Michael Leathead from EFG International to look at the fixed income market and what's been happening and what are the possible implications. Gentlemen, thank you very much for coming in today.
Thanks, Monica.
Now, Dan, we'll start with you first of all. If we look at the income market, if in your research you say that in order to understand the current volatility, you have to step backwards and have a look at see where this all began, why it was low volatility to begin with. So could you talk us through a little bit about these trends beforehand, please?
That's right. I think there's really three things to consider. First of all, post-global financial crisis, it's been quite a weak and uncertain economic environment, and that's really helped to force government bond yields lower, that uncertainty, that weakness in the general macro situation. And at the same time, as government bond yields have fallen lower, so that's encouraged people to reach for yield, and that's meant that spreads have continually tightened. And we think of it as a sort of cascade. So originally people were buying credit and then they were pushed out along into high yield and finally into the emerging market space. So spreads have tightened. Then finally the sort of icing on the cake, and I think really what's been responsible for this final push down in yields has been Fed policy. So the Fed has obviously had quite an aggressive policy of buying government bonds over the past few years, and that's really been responsible for driving yields lower over the past couple of years. I think the volatility that we've seen recently is really associated with the last point, associated with uncertainty over the Fed and what it's going to do in the future. And I think what we need to consider is what sort of volatility have we experienced. And what we've seen was roughly a 40 basis point backup over May. And that backup is, we've seen backups over 40 basis points about 15 times over the past 20 years. So they happen roughly once every three times out of every 4 years. And but what we have seen is that there's been a reduction in the frequency at which they've occurred. So we've only seen a few instances over the past few years. So it's been a relatively unusual experience, and that's part of the reason why it feels so uncomfortable.
Now, Dan, as you mentioned, the slow recovery has been discussed for some time, but the catalyst, if you like, is this action from the Fed, or the anticipation of action from the Fed. Would you agree that is the case? Yeah, absolutely. So what we saw really at the beginning of the year was there was a great deal of certainty over the amount of liquidity the Fed was going to be adding, and that helped to drive bond yields lower, as we've discussed. But this uncertainty more recently over the pace at which they're going to be tapering those Treasury purchases is responsible for market volatility. So what we saw over May, for example, was a 40 basis point backup in 10-year Treasury yields. And these occur, or have occurred, about 15 times over the past 20 years. So roughly once, 3 times every 4 years. So reasonably common, perhaps more common than people think, but they've just been less frequent over the past few years. The Fed policy and what's going to drive that is predominantly what's happening in labour markets and the general economic environment. The number that people are focusing on is non-farm payrolls, and those numbers have been relatively robust this year, averaging just under about 200,000 a month on average. So consistent with a steady improvement in the labour market. But the Fed aren't just looking at non-farm payrolls, they're looking at a whole range of labour market data. And they're looking at other things such as initial jobless claims, they're obviously sensitive to the unemployment rate, and also looking at things such as labour demand. And again there we've seen this steady improvement in labour demand. It's flattened out a bit more recently, but the sort of numbers which are consistent with an improving economic backdrop. And I think that's why we're seeing this debate going on in the Fed, and why at the moment, if data continues in this same vein, they would likely see tapering some point in the fourth quarter of this year. It is obviously all correlated, but if we look at yields for a moment, what sort of range do you think they're going to be trading in as we move forward?
Well, the sort of range that we've seen over the past couple of years has been between around about 1.7 to 2.3% on the 10-year US Treasury. So that's sort of defined the range and the way we think about it at the moment. What can happen, obviously, is that these ranges can shift over time, and potentially the slowdown in Fed purchases, that tapering effect, that has the potential to lift this range a little bit higher. At the moment we're at the top end of the current range, and that's the way that we're thinking about it, but we're also being vigilant and paying attention to the possibility that this range is shifted higher.
Okay, thank you, Dan. Now, Michael, we'll come over to you and we'll talk strategy for a moment, if you like. Now, I understand that the sharp correction in Treasury yields has left, some dislocations and dispersions, if you like. but they're still maintaining a little bit of opportunity there. Could you tell us a little bit more about how you're positioning portfolios and what strategy would investors should adopt at the moment?
Sure, I think it's important to look at how the markets have been performing so far this year to understand perhaps where the opportunities lie. Certainly in emerging markets, which have been particularly hard hit in the recent sell-off, we saw a very tight dispersion in spreads, and there wasn't a lot of opportunity maybe for fixed income portfolio managers in active strategies to take advantage of trading and alternative selections in terms of credit. I think what we've seen in the market panic, if you like, is investors cash in, take some profits, and they've done that without necessarily a rational thought for what the best returns are likely to be. So we've really seen some irrational moves just in very sharp and short bursts. And for active managers like us, that means that we can switch our positioning around in order to really capitalise on the opportunities there. We've been able to increase our credit quality and not really give up too much yield. We've been able to reduce our duration and not give up too much in terms of yield, and really look at the opportunities to increase the credit quality of the portfolio and not really sacrifice in terms of returns. So we've been looking for bonds which have had deep market corrections and switching them out for bonds which have not corrected quite so much. And I think emerging markets are really one of those markets where liquidity is more of an issue, and therefore you see these kind of corrections much more frequently. We saw it in 2011. We're seeing it again today. I think if you look at the economic fundamentals, as Daniel said, they're not really changed as yet, and therefore there's no real reason why spreads should be that much wider. I think it's a good opportunity to really get in and trade those markets.
Well, gentlemen, thank you very much for coming in today. Dan, Michael, it's been a pleasure hearing your perspectives and talking it through with us. Thank you.
Thanks, Monica.
Well, that's all from myself and the guys from EFG International today. Please do click back to Dukascopy TV for plenty more exclusive interviews and, of course, today's press review. Goodbye for now.